All right, we are live, baby. Welcome back to the Applied MMT live stream chat. Glad to have you here. Ty, glad to have you back for what promises to be another very exciting week of the most exciting, most educational, definitely the most accurate macro live stream on all of YouTube. Number one, baby. Number one. All right. Last week was a great success. We covered a lot of fun stuff. We started the groundwork for really what I intend this entire kind of live stream season 3 to be, which is let's get deep into the theory. Let's understand what actually drives the macro economy and tie that into markets. And I think we successfully pulled that off last week. And this week, I think I want to talk about what really is probably at the heart of almost everything we do, and that is the insights from Hyman Minsky. I mean, I guess I will say, and Ty, you're probably similar in terms of the influence, but for me, I think the biggest influence, at least in terms of my kind of intellectual pathway, would be first and foremost MMT, Mosler, and everything that was developed through that train of thought. But then of almost equal importance, if not, would be what Hyman Minsky came up with back in the 70s, 80s, and 90s, and then ultimately what Steve Keen built upon from that, and your work as well in terms of Minsky's instability hypothesis and really just understanding how endogenous money gets created and the impact of that. And so I know that I am always excited to talk Minsky, and what we set up last week was we talked about Goodwin, we talked about the interplay between profits and wages. That is a core piece to this, but the driver of what we all know as capitalism is what Minsky identified as this endogenous credit creation cycle, and that's what we're going to discuss tonight. I don't know if you have any thoughts on that, where Minsky is in your mind, in your thoughts, and where he's at in your own intellectual macro development, but give me your thoughts.
So this is a phase where you're just coming out of crisis and you're in a recovery. Banks and borrowers are quite apprehensive to do anything. So you would have somewhat of a restrained economy and credit growth. And then you hit into phase 2, which is the speculative stage. And that's where bank lending becomes a little more active. There are opportunities out there that capitalists want to pursue, and they are willing to take out loans for it, and banks are willing to give those loans. And then you get to the final phase, which is your Ponzi stage. And that's where investing becomes excessive. You're investing in riskier and riskier assets that don't have the same returns as the previous phase, and you end up in another financial crisis. And Minsky, verbally articulated this. He tried to use like an acceleration model by Hicks, and he never really got it to work because it was an equilibrium model. And Steve Keen came along and used a dynamic continuous time model to kind of demonstrate that function with the 3 phases in continuous time.
And that's ultimately, I mean, that really is what did it. And you could say that Minsky was proven right in 2008. But from a modeling standpoint, it really was when Steve Keen came along, did his original dissertation work in the mid to late 90s, and then ultimately had the software developed that we're going to look at later tonight. I mean, we're going to look at kind of the essence of it that ultimately, I would say, really proved the heart of what Minsky's trying to say, or at least shows that, like, yeah, you can build a model to generate the the outcome of what Minsky understood.
So Minsky really approached it from like a one cycle perspective. And whereas Steve came in, he kind of took it a little further, and the emergent properties, system dynamics is kind of the discovery of emergent properties. He actually found continuous business cycles declining over time, i.e. the great moderation, followed by a crisis. So that's kind of Steve's extension to Minsky. So he demonstrated that this Ponzi finance is a long-term multi-business cycle event.
Yep.
Where it seems like we're converging to some sort of equilibrium, and everything's great, and all of a sudden the system breaks down, we go into crisis, and then after that it goes into what's called debt deflation, which is kind of an Irving Fisher thing. But Minsky, as I recall, was one of his influences was Irving Fisher. And so Steve's model, without actually intentional design, really modeled a lot of what Minsky was saying during his career. And that wasn't, so when you model something, you're using stocks and flows. It's really actually quite amazing that Steve took his separate approach based on, the intellectual designs of Minsky, but then did his own modeling, and those emergent properties emerged, which really validated Minsky's, groundbreaking work.
Yeah. Yeah. So a couple things. We're going to jump into the model in just a second here, and then also chat. If you're in chat, say hi. I've seen a couple names pop in. Steve, sorry too, by the way, Ty. I cut off like the first 15 seconds of what you were saying in terms of the audio, but I think we're good. I don't think too much was missed. But anyway, Steve, glad to see you here. Vladimir, welcome back. Dan, good morning. It's evening for me. Tahir also got a question there. Maybe we'll jump to that at the end of the stream. But chat, if you're hanging out in chat, say hi. And like I said, we're going to pull up Ravel in just a second and actually show you the complete dynamics. I'm going to tie this all in real quick to the broader macro perspective, because for my interest, and what really kind of intrigues me is I think I thought Dan, you were in Australia. For me, what I'm looking for is what are the actual necessary conditions for crisis, right? Like there are clearly really bad malinvestment bubbles that show up, what seems to be yearly, right? Like we had a mini blow up at the beginning of August because of something that apparently happened with the Japanese yen carry trade, and we saw this effectively 10% sell off in very short order. And you can go back to early 2023. You had the SVB blow up. You can just go back in time and just see all these crises that emerge, and it's like why was 2008 so bad? Why was 2000 so bad? Why was the 1970s the way they were? Why was 1929 so bad? And how do we know if we're there? And how do we know how we're getting there? And what is the data that we want to understand as we're getting to those sort of points? And where is it as the cycle evolves? Where is it that we need to be most concerned? And Minsky gives us that insight. I think the thumbnail I made for this is like, Minsky knew what causes market crashes. He understands why we have the difference between what happened just a couple weeks ago, a 10% sell-off and then a rally, versus what happened in 2008, where we had a complete market reset that took us 2, 3, 4 years to finally get out of. And everything I do in terms of the credit cycle and the endogenous money cycle, I know for the past 3-4 years I've been so heavy on fiscal flows, but at some point those fiscal flows will give way, and there is this other economic engine, this other economic cycle that is creating this, as you say, this emergent behavior in markets. and it is this endogenous money cycle that Minsky absolutely understands. So that is to tie it into markets and understanding why this is important. Once you understand Minsky, and by this I mean, you know, the crux of his theory, you can really start to place yourself in the market cycle and where you're at much better, much more accurately. So with that being said, I'm going to go ahead and bring up the AppliedMMT 2.9. Now, we teased this out on Twitter just the other day. Ty, you brought that up. I was very excited myself to get my hands on. We'll demonstrate by the end of the stream. This will keep some retention here. At the end of the stream, we'll show off some of the other stuff that we're working on, some of the cool things that we're building in the background. But let's pick up from where we left off last week. Last week, we talked about the production function. We discussed everything that really just needed kind of the core. What's an economy? Like economy. What's an economy 101? Now let's build onto that, because the piece that we left out, and the piece that we left out was, hey, by the way, what's actually driving this growth of income for workers and this growth of profit is not only the fiscal side, but probably even more importantly in terms of the dynamics we want to look at tonight, firms are taking out loans, and that's doing something. So let's maybe pick it up with that general idea of where we left off last week, and then kind of go from there. And Ty, you can kind of walk me through what we're seeing.
Yeah, so if we kind of talk about the credit cycle, we can go to the investment function. And that function really represents what I was talking about earlier about the 3 different stages. And it's basically an exponential curve where stage 1 is kind of the low flat part of the curve. Stage 2 is kind of the inverse part of the curve. And then stage 3 is when you're going exponential.
I'll go ahead and hit play here just so they can see
there
the curve that actually ends up functioning over time. There you go. And I'm going to go ahead and pause now.
Yeah, so if you were to partition that into 3 subjective parts, the top part being the Ponzi phase, the middle part being the speculative stage, and then the hedge phase being kind of the flat area of that exponential. That kind of represents Hyman Minsky's function. And of course, we're doing it here dynamically. And what this function is doing is ultimately firms have profits, and they will take those profits after, dividend payments, share buybacks, et cetera, and they will invest in new capital, creating the ability to increase output. But there comes a point, and generally maybe in the more late speculative stage or the Ponzi stage, where they're actually spending more on investment than they actually earn in profit. And we're speaking in aggregate here, not just an individual company, but the economy as a whole. So what happens when you spend more than your profits? Well, you need to have those funds somewhere. So they go to the financial sector, banks generally. And again, I'm speaking in aggregate, so the financial sector, and they'll take out a loan. And so now they're really in the speculative stage where, the good times are never going to end. We might as well take out loans and just plow it into whatever capital we can find. And this becomes a positive reinforcing feedback loop for the system, driving up that Ponzi stage even further, until ultimately the capital is that you're investing in is so diluted that it has zero returns, or the costs of servicing that capital. So it could be your input costs, could be wages, raw material, actually become so high versus the return out of that capital, it becomes basically a Ponzi scheme. That is like a big driver in our business cycle. And there's nothing wrong with that per se. Like the constant growth of credit should occur with the constant real growth of our economy. The problem comes in when you have acceleration of your aggregate credit surpassing the acceleration of your actual output. And that's where we can start seeing the instability. And we represent that with private debt levels, but really it's that acceleration cross where you run into instability in the system.
You said something that intrigued me. Repeat what you just said in terms of when the acceleration of credit outpaces output. What is the dynamic that's happening there? What's the interplay that's happening there that's making that particularly dangerous?
Well, so the main thing is, in a perfect, ideal, hippie world, you don't pay interest on loans. But in the real world, you pay interest, right? So you can service your interest costs so long as your output is keeping up. You're making a profit to pay for servicing the debt.
Yes.
You can increase your debt load, increase your servicing load, so long as you're making the additional profits.
Yep.
Oh, look at this, Adam.
Right.
Adam's in the house.
And just
Adam
in time,
is in the house.
We've added Adam. Adam, welcome, man. Welcome.
Hello, gentlemen. Been a while since I've done one of these, but good to see you guys.
Glad to have you on. We were just discussing really the pinnacle of macro theory, and that is what happens when debt over-accelerates and overcomes output. So keep going, Ty.
So what happens? So as I just explained, like you can have ever increasing private debt levels, or private debt levels, so long as your output's increasing along with it, so you can service your servicing costs. The problem is when you see an acceleration of aggregate credit accelerating faster than aggregate output. So now you've hit the inflection point where future profits are not keeping up with the future servicing.
Yep.
Right. And that goes back to Steve's actual breakdown in his simple toy model. That's the reality of it, is you have to service that debt. And the big problem is in what we saw in 2008. Not only did we see, if you looked at it in aggregate, the acceleration of credit exceeding the acceleration of output, we also saw interest rates rising at the same time towards 2007. So that just, increased that burden, right? So
on the cost side of the firm.
So it's one thing to accelerate your credit past your output. Okay, well, maybe you can manipulate some things on your books and the economy in aggregate can kind of drag along. But if you move up your bank rate, so we're talking in aggregate again by, let's say, 25 basis points, and your credit's accelerating faster than your output, that's a recipe for disaster.
Yep.
And that's what we saw with the high private debt levels in 2007.
Now, Ty, I know that at least from what I've as far as I can tell, Warren Mosler is one of the few guys that cites, the rising oil prices right around the financial crisis as a big reason for the crisis, and that it pushed the cost of production up for everybody, and it effectively acted as a tax hike on consumers. How does that play a role here?
That's 100%, because so energy is like an input to almost every productive, like good making manufacturing facility on the planet.
Right.
So it's 100% do I agree with the change in energy costs. You'll see the change in energy costs is highly correlated with the change in inflation, right? It's like the main cost for everything. And as I recall, during that time down in the States, at that time, maybe it was $150 a barrel.
Oh yeah, we reached like
right?
170, 180 for a couple of days there, right as we were heading into the worst of 2008. Yeah.
So not only do you have your high debt levels that you have to service with an increasing interest rate, you also have a high input cost, which is energy, which is an input to everything we do in the economy. So it was a perfect storm.
Right.
Now, to say, do we take energy out of the equation there? Let's say it was at $80 a barrel. Maybe the crisis is pushed off into the future a few more years, or vice versa. At that time, maybe we had high debt levels, but interest rates didn't go up too much. But we had the high energy costs. Again, with the lower rates, then maybe we pushed it off into the future. There's no by means, there's no one cause in a complex system where you can say, oh, that's it. That high interest rates, I knew it, I got you. Right? There's always a multitude of effects in there, and definitely high energy was a factor.
So that's definitely one of the things, and just kind of for the viewers and the listeners, that over the last few years, and certainly in the time Ty and I have been kind of working behind the scenes to come up with some of the ideas that we're putting into this model, and just, I mean, anyone who knows complex systems, who understands, I mean, things even like chaos theory, and you don't know what element it is in the soup that is the macroeconomy that at any given time can actually be the thing that triggers the cascading event that leads to crisis. It is, but what you do know is where you're at in that cycle, right? I mean, you can understand what the main drivers of the cycle are, and it just so happened that we had like just the entire economy, at least the financial economy, built on these mortgage-backed securities, and there was obviously this very brittle foundation there. And then on top of that, it was also just the confluence of costs that all hit at the same time with oil. But maybe we get that exact same thing again, but because certain elements in the broader system at that time are just at a different spot, right? In their own evolution of the cycle, and those things don't then end up causing a crisis. And that's always, well, I mean, that's why you build these sort of tools out with the sophistication we're trying to do, to then simulate, okay, what's the effect going to be if we jack oil up to $200 a barrel today, right? You know, what is it going to be 6 months? Is it going to be 6 years? Is it going to be 2.5 years? What level? Let's say, private debt grows by another 20% over the next year, and then oil hits, those are the simulations you can run. So it is, I think to me, that's one of the things I've learned, again, is just like, it's very easy to always look back in history and say, oh, it was the housing, and oh, look, housing's getting pricey again, there's got to be a bubble. Well, no, I mean, the reason we're always wrong every time about about what the big short's going to be this time, it's because it's just so difficult to know where you're at within the larger kind of macroeconomic cycle at that time, and what could be the thing that kicks the thing off that ultimately starts the cascade down. Let's see.
Yeah, no, agreed. And also, to kind of add on to that, you can have a policy that works in one stage of the business cycle, and it's not so effective in the next stage. So, and this is just hyperbole. We'll say, monetary policy is more effective on the upwards trajectory of the business cycle, and it's less effective on the downwards. I'm just making up an example, but that's something we need to really start to apply to macroeconomics, is that one policy doesn't work the same depending on the state you're in of the business cycle, right? And of course, a multitude of other factors, one being, the private debt level. For instance, we've got one of our friends on the other side of economics saying that we see a lot of the same similarities as 2008, but for me, we're nowhere near 2008. Especially down in the States, you guys have a very, very low private debt level to GDP. So I don't see any
relative to where we're at in 2008. In the time leading into 2008. Yeah. I want to make that very clear. If someone looks up private debt to GDP, it is low, but it's low. It is technically high, and much higher than we were at, say 2005. But it's not like low like it was back in 1991. I just wanted to make that clear.
Low as a percentage of disposable income.
Yeah,
but it's
it's
a nice scary graph to post on Twitter.
And then relative to Canada, we're very low. I mean, my understanding is, I think that's a point you were trying to make.
We're at 200%.
Oh yeah.
But I'll tell you, the number itself doesn't mean anything if you have physical flows supporting your economy, like Canada. I know you Americans, you love to call us socialists and communists, but we have strong government spending up here. So, a lot of people said, well, look, you've got that high private debt ratio, why aren't you seeing a collapse? Well, we've got really great federal government spending all the time up here, right? So you can support that because that becomes the profits for the private firm sector, right? So they can support the higher servicing costs.
And don't you guys export quite a lot too? You guys are net exporters, so you're gonna.
Yeah, generally we are, or we're right close to balance. There's a few years.
Okay. Yeah. Speaking of the fiscal side, Dan brought up in terms of what is the determining factor of fiscal in this larger picture, and up on the screen right now, one of the things we're building out is this idea of a very strong countercyclical government spending. In other words, it's our way as we continue to simulate this out to force the government's hand to go ahead and spend. And what we see in history is it is when the fiscal gives way, and it usually gives way just due to the nature of the cycle playing out. Government spends, that kicks off a very heavy credit cycle. That credit cycle in turn generates a lot of business activity, which in turn generates a lot of taxes, which then in turn kind of creates a surplus, right? Because the taxes just get so high because the credit cycle gets so large in terms of the overall economic output. But yes, if you turn off fiscal, like we did starting in about 1997-ish, it puts all the pressure on the system that's in front of you. We did it in 97 into the dot-com. We did it again in 2007. And if this cycle is in the right place at the right time, it does end up blowing up. So the fiscal is very important. Ty, what do you think about me hitting play on this? And one of the things too is we've built this new model. So this is 2.9 for those of you who are keeping track at home in terms of exactly where we're at. And I mean, this is what Ty teased on Twitter earlier this week. And we're going to go with the macroeconomic data because it's a little easier to simulate the at least at this point, kind of the Minsky portion of this. But what we've done is we've started to build some of the theories that I mean, essentially, I think are true into this, in that there's particularly just in terms of how inflation functions and how rates work as well. And Ty, one of the things you were explaining to me as we were discussing this before we went live is this is a little bit. We've kind of built this to be a little bit more stable, not in the sense of we're trying to do it that way. Maybe a better way is it's a little bit more difficult to bring this plane down just because of the way that we're doing this, which is also then a little bit more consistent with reality. Like, you really got to screw up, which we have before, to bring down the macroeconomy, and that we're going to have to play around with some of the levers in real time to go ahead and demonstrate kind of what it's going to take to really run this thing into the ground, which we will try and do. So if you want, Ty, you were going to say something, go for it.
Yeah, so the big difference is our theory on the price level and how that changes has been adapted. Without getting technical, we're taking into account inflation going up and being a cost for a business, and we've injected that. So when we make interest change adjustments on this model, we don't get the downward cycle for inflation anymore, depending on what part of the business cycle you're in, which is kind of cool. So it goes to show that in this simplified model, monetary policy is not reliable. It's not to say it's not effective. We just need to know when to use it. And it's not a tool that can be used willy-nilly at any time of the cycle. So that's one of the changes. And the other change too is, this is just a fundamental one. Before, in our financial sector, we didn't have it paying out dividends or wages back into the economy. So in the Steve Keen model, for instance, that's ultimately the debt deflation, because banks are just hanging on to their equity or their profits, their net profits over time. Well, in reality, that gets paid out to wealthy people, which are part of the household. So that's what we did, and that gives longevity to this model, but it also adds another two system states, and it introduces a little bit of chaos. And I've talked about this before. When you have two system states, you tend to, if one's a positive feedback loop and one's a negative feedback loop, you just get a never-ending cycle, like the Goodwin model. If you add a third system state, like Steve did to the Goodwin Minsky Keen model, then you get instability out one end. If you add another system state and multiply it together, then you start seeing chaos, and you're like, this must be random behavior, but it's actually still all determined. And that's what we're starting to see in this model, is we're getting a little bit of chaos. And I kind of finished the interface off today, and I didn't really have a lot of time to do some tests. And what I do test with, if you guys want to ever look it up, is your Argon values. And that shows the dominant feedback loops in the model. I did not sit and do those equations today, but that's something I want to do this coming week to really understand what's going on, to kind of start identifying, okay, when's monetary policy effective? When's fiscal policy effective, right? When is increased, private credit, if we have control as a system, when is that good in the business cycle?
Yeah.
And that's really the deep research that I still have to do.
Question for you, Ty. When you say, when is monetary policy effective, do you mean like in the conventional sense, like the idea that raising rates will slow the economy?
Yeah. So in this model and just early runs, I've had situations where it actually accelerates the business, or depending on what point, I can reduce employment, like the traditional theory is, but inflation goes through the roof. So it doesn't have that combined effect, right? So those are things I kind of want to test the Argon values to find out what are the dominant loops, right? And then I can identify what points in the business cycle monetary policy per se, like if we're talking about monetary policy, is effective. Then I can go look at the data and see if I can correlate any of that in, the past data. For instance, this past bout of inflation, really tough right now because we were at 0% since 08, essentially, right? And we've had one bout of true inflation in 2021, 22. So that there's sparse data, really. So I'll have to go back further, but the further you go back with economic systems, the more the structure of the systems changed over time. So it's a complex thing to really look into.
Let me elaborate too, Adam, and because you're the question we're asking is good, and the things that Ty were saying were really good. And so just so everyone at home understands, the debates that we've been having are two or three fold here, and that debate point number one is I am of the impression that interest rates, when they are raised, are generally inflationary and expansionary because of the fiscal channel. And that is something that's already been added into the AppliedMMT version 1 that we created. But it was more than just the fiscal channel. And then one of the discussions that Ty and I had is that, and actually I'm going to bring back up the wiring because I think this shows really well. And Ty pointed out is, let's see, where is it here? Where's the cost for the labor production? Where's the interest cost for labor production?
So zoom, you're right over top of it. So zoom in. I've kind of had to put it in a whole new box because I put a bunch of new variables in.
Okay.
No,
is it
this?
Oh, okay. Yeah. Oh, yeah, there we go. Okay.
Yeah.
Okay. So one of the things that Ty pointed out when we were kind of having our debates back and forth is he's like, hey, Doug, you're right that higher interest rates are actually, they're adding additional interest income, but higher interest rates are absolutely a cost to firms. And so every time we would run, I don't see where the cost is, but I trust that it's one of these.
It's right on. Yeah, it's one on the side there, right above the T, subscript T. But basically, that the interest cost is a cost for the firm. So obviously, if they are spending more on interest, they can't spend as much on investment in R&D.
Yes.
And that is a definitional drag on output. There's no school disputes that, including MMT.
So the question is, how come, at least from my perspective, empirically, every time we get the kick, the start of a credit cycle begins with interest rates actually going higher, right? It seems empirically correct to me, at least in terms of the statistics work and just my, everything that I've kind of thought of, and that then dovetail into another discussion that we were having, again, just so you understand where we're at thinking this through, about inflation and the impact of inflation on investment, and this idea that when inflation pushes higher, there's actually an even higher grab for higher profit margins, which in turn creates more credit demand, which in turn creates more profits, which in turn creates more inflation, which in turn creates a higher grab for even higher profit margin. And then you get this kind of reinforcing loop that continues the cycle higher. And the thing that kind of dawned on us as we were talking is it's like, yeah, hey, companies, firms, when they're doing their planning, they're not going into the spot market that morning. I mean, I'm exaggerating a bit here, but it's not like they're going in the spot market that morning and saying, hey, I need a ton of steel. Let's go ahead and get that delivered today. No, they're planning out for next month, next year, and so on and so forth, depending on their own needs. And I think one of Warren Mosler's insights is that when the Fed raises interest rates, that's also raising the future cost in terms of the term structure of prices for any given commodity at that current time frame spot price. So I'm not saying it's raising the spot price. What I'm saying is that the spot price today is $1,000, and at a 0% interest rate, the contract cost for next year would also be at $1,000. The minute you put an interest rate to 10%, next year's now incurs that cost of that contract that today cost you at 0% interest $1,000 now will cost you $1,100 because the interest rate now is $10 because you have the ability due to the cost of the money to just go ahead and get the risk-free rate, and so that gets embedded in the term structure of prices, and then that then becomes this kind of part of accelerating this inflation, offsetting the lag that you would get or the drag that you would get from the cost of the cost of the higher interest. So that was a lot. Hopefully you followed that. We will go into that part in more detail, but I wanted to get that out there because it really is the crux of what makes what we're doing just different, and it is part of the really, to me, a very fun debate, spirited debate that we're having to test this out. And that's what I mean, no one else has figured this out. We are, and this is the way that we're going to figure it out. So with that being said, Ty, I know you've ran some of this and you showed me some screenshots, and some of the behaviors that we're seeing in these models are well, they're fun. So let's go back to this. And Ty, I turned the interest rate up to 5 and the dividend time constant down to 0.5. Should I turn the interest rate higher?
Put it up to 6%.
So what we're going to do, what I at least want to demonstrate at this point, and by the end of this live stream too, we're going to look at some real data as well, and then piece this all together with kind of live data, macro data. But what I at least want to do is I want to collapse an economy at least once, see what we got to do that. So Ty, if you're good with this, I'm going to give this a run, and then just so everyone knows, at this point we've turned off government spending effectively. There's an initial stock of government spending, and then we're also using kind of classic post-Keynesian price theory as well. So we're not using what we'll call applied MMT theory at this.
Hold on.
We are using that theory. We are.
So you can turn. Now that's kind of a testing thing. It's not really part of the model. We could turn that off just to see how it runs. But
Let's do it.
Yeah, I've made a lot of. Yeah, I don't know what's going to happen with it off because I made a lot of parameter adjustments. But let's see if it works.
This is fun.
Yeah,
this is fun. All right. Here we go. So we get the normal cyclicality right out of the gate that we immediate crash. Oh yeah, baby. Oh yeah.
So
all right.
And that's kind of what I expected to happen because now with the new system, interest at some points of the business cycle is actually quite inflationary, and is actually driving income back into the economy because that goes to the banks and then is paid back to households, which they consume, which becomes profit. Right.
Yeah.
So it actually drives growth depending on what part. And so I had to change a lot of my functions because it just made the economy go crazy. And so your functions are your behaviors that a collective group of people will do. And those functions, like in real life, are developed year after year after year by, thousands of traders, thousands of capitalists, right? Thousands of managers of factory floors, right? So they get adjusted, over the years. And they look fine-tuned mathematically, but it's a slow evolution anyway. So I had to change those functions. So now you can turn on our new pricing theory, which we're still developing. It's it's kind of groundbreaking stuff, and then run the model and see what happens. This time, I think we'll get the more traditional, moderation and then instability in the system. And this is now where we, it's become like chaotic behavior where you think, well, this is random stuff. It's actually all determined, but it's a chaotic system. And actually, if you go to the phase plots tab, you'll see kind of like the Lorenz butterfly in the bottom left corner, right?
Yeah,
that's a complex.
Versus.
Okay. Yeah, that's a complex system. Now you can go back to it, right? That's just kind of a lame chaos theory.
No. I was curious where employment was anyway. So that it's doing a normal cycle.
So in the old model, you could lessen the business cycles by just raising interest rates. So try to raise interest rates to 6.5. Let's see what happens. Let's see if we got a new lower low and a higher high for some reason.
Which, to be honest, I think that's exactly what happens when you raise interest rates. You get an immediate revaluation lower. I know we're looking at change of output there, but then you actually then recover the cycle.
Let's just try another thing. Let's say the banks get stingier with their dividend payments.
Okay.
So in your time constant, turn it up, the dividend time constant.
And just to be clear, when we say they're getting stingy, this is the pass through that's happening from banks out to
correct.
Okay. And by turning up the time constant, that's the amount of time that they're going to hold on to it.
Yeah.
Okay.
Essentially, yeah. Mathematically.
All right. Well, I turned it very fast. But we're recovering. Okay.
Yeah. So that's you just took a bunch of income out of the economy.
Okay.
You've crashed it.
Okay.
That's game over. That's nuclear war with Russia right there.
Well, no, that's just
we're done. We're done. We're pressing the buttons.
The greed got too much.
Yeah, the banks were too greedy, but that's kind of a small example of the new feedback loop we've introduced, right? Is banks they're not creating productive goods, but they are providing productive income for the households to spend. Now, the distribution of that income, obviously we can look at the data and see it's skewed to more wealthier people, and that's a political problem. But the bottom line is the banking sector isn't necessarily the financial sector isn't that all parasitic component that is easy to make it out to. It actually plays an integral role in keeping our economy going within reason. Obviously, they can become too greedy. Their market rates could be too high, so exploitive. But they're a vital part of our growing capitalist society, right? To say they're parasitic, I think overstates. That's a strong word.
So just so the viewers are knowing, I turned on government spending now in this cycle. So
okay, if you've turned on government spending, you better turn up taxes to, let's say, 4%, because you're essentially filling up a bathtub without draining it.
If I is 40 times 10 is in this, that's
at 0.04, I think it will be
40.0.
0.04.
Okay, mine's saying 40.0, but I assume that's 4%.
Yeah.
Okay.
Turn it up some more. Let's see if that's a extreme business cycle for the model.
Okay.
Now turn off government spending. It's way too much government spending.
I agree. We gotta vote someone to stop this.
Right. And then turn up then kind of finesse your tax rate, right? And it's hard to run a model when you're running it on full blast to make these adjustments. But you should be with the proper manipulation. You bring it back to that small little tiny cycle you saw in the first 10 years of this run, right?
Yep.
Like I've done it a couple times, but you've let things go. I don't know if you should be the Fed chairman, Doug.
It is interesting. I mean, this is obviously quite obvious that now the private debt level is going to start to increase, which we're seeing. Yeah. What I want to do now is I want to actually massively reduce, now that we've removed fiscal completely and taxes are coming in, I want to actually start to reduce the interest rate and kind of reduce it quite dramatically.
You're gonna have the central bank purchase the treasuries from the banks.
This is absolutely fascinating.
Now think about the logic here when you do that, like you just did too excessively. That is your interest income supporting the economy without physical spending,
flows, which is
you just crash the economy, right?
Which is exactly this is so much fun. The problem, Livestream viewers, is we do this all ahead of time usually, and I get to have my wow, this is so cool moment. But you guys get to see it live, because this is exactly what we see play out in reality. Is you see the Fed drop interest rates at the most inopportune time, right? Like in 2008, heading into the great financial crisis, I think the Fed starts dropping rates in 2006, 2007. I'll pull it up in just a second. But then, they're going full zero as we're in the heart of the crisis. And, the kind of the MMT argument always is, you're just removing the very last drip of fiscal from interest income out of, just removing that channel. You're also collapsing inflation by doing that. And we actually saw that play out in this model, an immediate collapse of inflation. And I think, as I just proved, cutting rates to zero as you're heading into a crisis, and because we took government spending out of the equation, actually doesn't end up leading to the sort of outcome that you would want. Ty, this is fun, man. This is fun. This is good stuff. I think this is very much in line with.
It's still very much beta and simplistic, but it's heading towards the MMT. I ultimately want this to be the applied MMT. Theory, right? Yeah. That you guys have worked on, right? So there's a ways to go there. Obviously the stock flow consistent part, that's easy. That's MMT, that's Win Godly. That you can't disagree with accounting identities. What we've got to work out is, the theory of production. Essentially, I've always advocated MMT is really great if you overlay all that stock flow consistent modeling over a private sector production growth model. I always thought, okay, well, that's the economy. Now you're dealing with real widgets if we're just dealing with one good, and we're dealing with nominal values at the same time to see that interplay to create the business cycle. And that's what we're kind of doing here. It's just, we got to make sure we're identifying the things that matter to applied MMT, and ultimately that's going to be, what do fiscal flows do to the S&P 500? What does the credit cycle do to the S&P 500? What does it do at different parts of the business cycle to the S&P 500 or whatever index you want to look at down in the United States? And so the other plot, this is really, and I think this is where Doug and I have always agreed on, is your rates of acceleration and finding correlations through that method. So a lot of economists find the strangest correlation. Sometimes they'll correlate a flow with a stock and stuff like that. But if you really want to look at correlations, you should be looking at the rate of change of the rate of change or acceleration, and then correlate those. And so this is just one of the other, and again, this is more of a testing tool, even though I made it into an interface, is okay, now I can start comparing my accelerations between different variables. And when I go and look at the Fred data, or it could be the Bank of International Statements data, and I start changing those into the rate of change of the rate of change, am I seeing the same behavior? And if I start seeing the same behavior there, then I can say, okay, you know, the theoretical underpinnings of our model are matching reality, not just some random correlations, but like acceleration correlations.
Yes. Yes.
That's
Yeah.
really, really important, right? One example of that, and because Steve's like a mentor to me, his big insight is the rate of mortgage credit is directly influencing housing prices. Now, he doesn't just have the level of house prices on a graph and then the flow of credit, right? He doesn't correlate that. He's correlating the acceleration of credit, right? And then he's taking the change of house prices and then the change of that, right? And looking at the acceleration. And then he's with that, you see, I think it was a 0.96 R value. And for people out there, that's almost perfect. It's very hard to find anything in nature that's at a 0.96 and not say, okay, that correlation, that has substantive meaning. There's some causal effect in the background. And that's when you look deeper. Okay, now what are the causal effects of that?
Yep.
And with system dynamics, we're kind of doing that at the same time. We're finding the correlation and we're building the structure of the model, the causal links, right? So we're kind of doing it at the same time.
The one thing I wanted to point out on this next page too is, and we'll jump very quickly to some Fred data to show how you can see where we're at in the credit cycle and how this all ties together with the theory that we've been talking about. But that is on this page too, the thing that we've added is firm equity, and you can see that we had a complete collapse in terms of firm equity as well near the end. I mean, I know this is still kind of beta tying this in.
Yeah.
So
I don't want anybody to look at that and say, okay, we've got that is the book value of equity in the firm sector. And what I've done is change that stock. I've taken the stock, what's the rate of change of that stock, and then what's the rate of change of that rate of change, right? So the acceleration. Yeah. And right now, it's just serving as our pseudo S&P 500
for now. And that's
for now.
Because at the end of the day, I mean, what Ty was trying to, I mean, I guess a payoff when you're an investor, really what you care about is, above all else, what is the return year over year of the S&P 500, and what's actually affecting the change. And I'm sorry, you care about your return, and why you care about your return is it's the change in your return that you're actually trying to predict, right? So in other words, if you're looking out into the future in terms of your investment and where you're at at that moment in time, what you're really trying to predict is what is the change of the return that it is that you're getting. Like, so, and that is why what Ty is saying in terms of you want to understand acceleration, because it's like apples to apples. You're measuring the rate of change of the rate of change on the inputs, which means you are actually caring about the rate of change of the rate of change, or the change in your return on your outputs. And just to give a little bit of understanding without giving too much away, in terms of like deep MMT and kind of the secret sauce that goes into that is crucial. That whole concept is crucial in terms of understanding that you're matching everything up correctly in terms of what it is that you're trying to forecast. If you don't, you're not going to know what you're doing. Well, if you haven't figured it out, you're not knowing what you're doing anyway. But you're gonna struggle to come up with any sort of kind of statistical significance that the model can then learn from. So either way, more than anything, I want to tease a little bit that we do have this idea of finally tying in some equity from the aggregate firm sector to get a sense of what we can expect, what sort of emergent behaviors emerge out of the system given the various dynamics that play out. So let's do this question. So the S&P 500 is analogous to the acceleration of firm equity. For now, what it'll work for now. let's just say it'll work for now. Certainly, there's speculative and other ways in which the actual price of the S&P can diverge from firm equity. Ty,
yeah, and think about it. What I could have also done, and I probably will in just an update, is I would actually include the financial sector's equity, because that's a big component.
Yes.
Of the S&P is the financial sector, so that's not included there. But I decided, okay, what's a good placeholder for now? What's a fundamental placeholder? And technically, your share should match, the fundamentals of an economy. Obviously, there's permutations that happen, right? Fluctuations, and we can build those in. But ultimately, the trend should be going with the equity, the book equity value of the firm sector. And it could be a multiple, so maybe 10 times 10. It could go up to times 15 when the market's really active and there's a lot of buying. But it should be with the trend of the fundamentals, you would think, hopefully, right? So that's kind of your guys' area more than mine, but that's kind of why I use that as a placeholder.
I like it. All right, let's do this. Good question, Django. And yeah, gotcha. First order approximation. Let's do this. Let's actually look at the data now, and let's show you how we kind of track this in real time and what it is that we're going to want to look for. And the first thing we're going to do is just the total credit to the private sector, to the private non-financial sector.
Doug, you do realize it's in a square screen because you've got it in your screen, so it's cut off on one side. Just so you know.
I think for everyone watching it,
or hold on, let me look at my phone. Oh,
I think you're good, Doug.
Yeah. You're good. Yeah. You're good. I'm looking at my Don't listen to me.
No.
I'm wrong.
So, this is just the total. So we're gonna look at three things. We're gonna look at just the total debt level. We're then gonna look at private debt to GDP, and then we're gonna look at fiscal spending to really try and put this into focus for how it is that we can see this in real time. And we're going to do percent change. So if you want to follow along at home, it's QUSPA MUSDA, and this is from the Bank of International Settlements. Total credit to the private non-financial sector. Important you get that there are a lot of various data on the BIS, so just make sure if you're doing this at home, you're finding the right one for this to make sense. The main thing that I want to point out here, and now that we've understood and really driven home the point, and this is, if some of this is like, I don't get why acceleration matters, why does this matter? This is why it matters, is because it's what you notice is when you, so now we're looking at the rate of change of credit. It's when you get those massive spikes that ultimately leads to a recession. And that's why it's so important to see when you're getting those spikes, which the spikes in the rate of change is that acceleration that, as Ty was explaining, as we saw modeled out, is the necessary first step to then start the collapse that happened. And I point to the 2010s, and this is just it's just an interesting observation. And I think, again, empirically, why I'm so convinced that 0% interest rates does something very interesting, unique, special to endogenous money growth. We never got a major acceleration, right? We never got above 5% in terms of rate of change of credit. And the first few years can be explained away by just deleveraging, a lot of fear, but I mean, by 2013, 2014, I mean, it was very clear we were past the great financial crisis. And it wasn't until the post-COVID timeframe where we got this massive fiscal push that we ever saw what I would call reasonable credit cycle emerge, where we got a real boom and bust out of a credit cycle. Of course, prior to that, we would get a credit cycle that emerged every we'll call it a cycle every 4 or 6 years, give or take over time. You'd get the full peak to trough of the credit cycle. But the main takeaway is the bust happens because of the boom, and you gotta have the boom. And right now the BIS data is very lagged. So if you want to see this slightly more real time, you're going to want to look at the H.8 data. But as it stands right now, we're at the end of the cycle in what was Q4 of 2023, right? Like, or really, I'm sorry, by the end of the cycle, what I really mean is we're past the end of the prior cycle and going into the start of the next cycle. I guess probably the better way to put it. You don't get recessions when credit is actually contracting year over year. That's when you get the new cycle to begin to emerge. That's when the phoenix comes out of the ashes. That's when you want to get aggressive and long, is when you're at the bottom of that current ebb and flow. Now, what's going to inevitably happen, I guarantee this, is everyone who's saying the sky is falling, Chicken Little was right, there are aliens in the sky, and they're coming to take us all, recession is right around the corners. I guarantee you 18 months from now, when we have a strong credit cycle going, they're going to be like, oh, the economy is back and it's going to last forever. They're going to bite right into it and just be like, yeah, this is so bullish. And that is finally when we're going to be like, no, these are the necessary conditions for crisis, right? And that'll happen. Again, it might be 18 months, 2 years, but that's when you'll know that we're about to go into some bad, well, I mean, obviously when the macro alarmists and the perma bears start to get bullish, that's probably when you do want to flee for the hills. But that is when you want to be scared. You want to be scared when credit has been accelerating for an amount of time because of everything that we just discussed. And the first chart to see that is the total credit chart. So I don't know if you have anything else to add to that chart right there.
You know what really bothers me is when people are, you're throwing up the alarms, and all I want to do is sit there. If it's on Twitter, I just want to tweet back. So you're calling a business cycle. Like, of course, one day there's going to be a downturn. Like, what insight are you giving me right now? Other than your downturns are like, nuclear, like annihilation downturns that never end. And then, we go back, we're up on the upswing. And like Doug was saying, the good times are forever now, right? And there's that. It just bothers me from like a theoretical standpoint. Like, it's the business cycle. We are going to have up and downs, right? So let's understand that cycle, right? Let's understand all the variables in a macro system. So we can look at it like a human heartbeat. The heartbeat doesn't, like, it beats and then compresses. Like, we're happy that that's happening, right? Because we understand it, right? I'm not saying that on the downfall, people are losing their jobs and we can use fiscal spending to correct that, but that's another story. But that is part of a capitalist system that we all want to live in. Like, I sell things on my own. I'm self-employed, right?
Yep.
Like, I want to live in that world. But part of living in that world is it's a cyclical nature of the capitalist system. So instead of fear mongering, let's understand that cycle. So we are, as an individual, don't want to sound Austrian here, you can navigate your way even on the downside. You're going to be okay if you're in the markets because you understand those macro dynamics.
Yep. Well stated. All right. Next chart we want to look at is the total credit to the non-financial sector relative to GDP. So the chart we just saw divided by GDP. Again, if you can see on the stream, that is the series number if you press it in a Fred. The reason this matters is because one of the things that we discussed is an important criteria for where we're at in the whole business cycle. And actually, I probably can just pull this back up in Ravel real quick, is the total private debt level relative to growth, or really the ratio of the private debt level relative to growth. And I'll just zoom on in. Eventually, we really, when the system collapsed, I don't know if you guys can see my cursor. When the system collapsed right here, hopefully you can see my cursor, the entire system just kind of breaks down, so the ratios go bizarre. But notice that as we were going into the collapse, the debt ratio really started to accelerate. And as we were talking about in terms of the dynamics of how this thing plays out, as the debt level continues to, the ratio of the debt of growth continues to take over more and more and more of the growth cycle, it is far more susceptible to those inflection points of things like profit getting eaten into by wages or by interest expense or by inflation, and it's just even the slightest slowdown in that acceleration of credit expansion can cause the entire system to collapse. What that means then in practice, in terms of when we're looking at the data as it's presented here, is eventually we will start to see private debt really start to take off again as the major ratio of growth in our macro cycle. And the higher this pushes up, maybe this cycle we get to at the peak in 2008, it was 171. So maybe in this cycle it'll go to 180, 190. But what you really need to be concerned about is when it really starts to amp up. When it really starts to amp up, that's when you need to be concerned. Is when we start in the credit expanding cycle, and you get a massive ramp up in the total level of debt. So Ty, I don't know, or Adam, I don't know if you have anything else to add to that piece.
Really, you can't really see it in that graph, but if you were to change that even to a rate of change from last year, then you would see the acceleration point, like let's say right before 2007, 8 there, you might see that acceleration take off at the tail end. And of course, this is comparing output too, so that might be maybe the wrong approach. Well, it's kind of hard to say because you're comparing GDP too, right? So that's in there too.
I don't like to look at acceleration on the ratio itself. I think I think it might be helpful in Minsky or in Ravel to track that. But in reality,
no, I agree. What I'd be looking at is actual the credit data, not the ratio.
Yeah, which is the one that we were looking at before. Yep.
Yeah.
Yep.
And then I would be looking for the acceleration on that.
The rate of change of the rate of change of this. Correct.
Yeah. And looking at that to the relatively to GDP and its rate of change.
Yep.
So.
The last thing I want to look at too, which again is the important component here, is all this really comes into effect when fiscal starts to wane, and more importantly, inflation adjusted fiscal. And so as long as we're accelerating, and again, I use a bit of a unique way of understanding what fiscal looks like. I like to take cumulative deficit spending and the change of that year over year inflation adjusted. You can just see on the chart that it gives you a lot more information about where we're at than kind of your normal deficit spending. But when you start to see a very strong deceleration in this, or getting even into just completely flipping and kind of effectively a surplus in real terms, that's when you need to be careful, in part because, again, it goes down to profits drive the credit cycle. And what the Levy-Koleski equation, did I pronounce that right, teaches us is government spending is the root of, or is a root of profit in the private sector as a whole in aggregate. And so you take away that channel and all of a sudden the weight of the entire economy is now reliant upon the dynamics that we just showed in Ravel to continue to play out, and the dynamics always end in disaster. And so you take this away, and that is certainly the one easiest sign to know that we're near the end of the cycle.
You got the names right too, Doug. I was pretty impressed by that.
Thank you.
Yeah.
I'm not known for my command of last names, the English language and last names. So that's the essence of how this all, what the interplay is between credit, between fiscal. And again, I just the way this works, it is so hard. I know we've been harping on this or just pounding this home week after week after week, but we are just not at the space, at the place where this is end of cycle sort of stuff. And
Right.
and if anything, we're just seeing, and I'll show you again. Here's like loans and leases. So this would be like the most productive aspect of credit expansion. I mean, we are just starting to see the takeoff happen here. And I just based on the modeling we have and based on the way the macroeconomy is currently set, there is absolutely a reason to believe that this cycle can take off for a little while. So that is definitely what I wanted to drive home tonight in terms of the points I wanted to make. Ty, Adam, you guys got anything else?
No, I concur with your points, Doug. We're going to be okay. We're going to be okay.
Until
There's
we're not.
no
Until we're not.
Until we're not, barring any exogenous shocks like, World War III, an asteroid. In that case, all bets are off. But right now, endogenously, we're doing okay.
And as the last 5 years, if that's taught us anything, we're fine. Crazy things don't happen. So,
Well, knock on wood, right?
Yeah. Or maybe you have a different recollection of the last 5 years than I do. But
to quote the meme, nothing ever happens.
Another exciting week. Adam, thanks for jumping on. Ty, great work with the model. Chat, we'll be back next week with some kind of continued stuff to show, and hopefully next week we'll be able to dive into some of the stuff that we've been debating, just because it's fun. If you're a macro geek, a macro nerd, this is fun stuff, and especially if investing, trading, that sort of stuff is on your horizon as well. I think this is, it is without a doubt the most valuable way to understand everything. Speaking of which, if you are an active trader, active investor, AppliedMMT.com is your place. And the other thing too, speaking of these models that we've been building, and if you're an institution, I mean, we're doing this with institutions in mind, with some bigger plans in mind, and we're starting to build some stuff out. We would love to talk to you. Click the For Institutions tab, drop a line if you're a large money manager or an institution. Yeah. Give us a shout. But otherwise, if you are just that active trader, active investor, and if, some of the data and some of the models that we put together as well, all available over there. I do updates every single week, and we've just been crushing it too. I just got to say, we've been having a ton of fun. This market has, this market has been great. And Dan as well pointed out, we've got the Discord server as well, and get all that there. All right. That is what I have for tonight. I'm just seeing one last second if there are any good questions that I missed, but I don't think so. So with that in mind, Ty, Adam, thanks for joining. Chat, thanks for being here. And until next time, good trading, everyone, and we'll see you then. Bye-bye.